far we've looked at the income statement and balance sheet. Now our attention turns to the cash flow statement. Bit of a heads up here, this is a particularly tricky area of the CFA Level 1 syllabus. So you are going to find some of this quite tough, especially if you come from a non-accounting background. Okay, so why do we need a cash flow statement? Well, the overview here, of course, is when we look at earnings in the income statement, they are not cash-based. Okay, why? Because of the accruals concept, meaning we're recording sales when the customer hasn't paid us the cash necessarily, we're matching expenses or matching costs against revenues, and we've got non-cash items in that income statement. So the basic idea, therefore, is your net income is not the same as a cash flow. Now, of course, companies go out of business because they run out of cash and can't pay their liabilities. As a result, what we're going to look at in the cash flow statement is how the company generated and spent cash during the period. Now, when we look at this, our first learning outcome statement here asks us to compare CFO, CFI, and CFF, and then classify items into one of those three classifications. Okay, so as we said, net income is not the same as cash. It doesn't tell us anything about how the company generated and used cash. So what we're going to need is a cash flow statement. Now, what the cash flow statement does is it reconciles last year's balance sheet cash figure to this year's balance sheet cash figure. So it's really telling you why cash in the balance sheet changed. And it's taking that change in cash and breaking it into three classifications. CFO, our cash flow from operations. This is the cash generated from our day-to-day business activities, so our core business operations. Now, it can be called cash flow from operations. It can also be called operating cash flows. Okay, so whether they call it CFO or OCF, don't let them trick you at all. The second source of cash flow is our CFI. This is our cash flow from investing. So this is really the cash that we spend and raise as a result of infrastructure. So it's cash that we spend when we add to our PP&E, our intangibles, our investments, any cash we raise when we dispose of them. And then the final sources of cash flow are to do with our capital structure, the way we finance the company, and debt and equity as a result. So this is our cash flow from financing. So what we're doing is taking the change in cash and saying, hey, what came from our core day-to-day business operations? What cash resulted from our investing? And what cash is a result of changes in our capital structure? Now, of course, the most important source of cash flow from an analyst's point of view is the CFO, the cash flow from operations, because this is telling us, does the day-to-day core business activity of this entity actually generate positive cash flows? So let's start with our operating cash flows, OCF, otherwise known as cash flow from operations. Now, what we're looking at here is a CFO, cash flow from operations, based under US GAAP. Okay, we're going to see when we come to IFRS, there's a little bit more flexibility of where items are reported. Okay, so typically I think if you're likely to be doing calculations, chances are it's going to be based under US GAAP because it's very prescriptive. It tells us exactly where each item should go, and there's very little flexibility behind that. So our cash flow from operations is the cash that we generate and spend in our day-to-day business operations. So it's the cash received from our customers from selling goods, any cash dividends received, any cash interest received, and any other sundry cash income. Maybe we receive some rental income, for example. Okay, then we've got our payments, so our payments to suppliers, so this is the cash payment to suppliers, our cash operating expenses, wages, rents, rates, that kind of stuff, cash interest paid, and then finally cash taxes paid. Now, when we look at this, you'll notice under US GAAP that we put dividends received, interest received, and interest paid through cash flow from operations. What you will notice is one is missing, and that, of course, is dividends paid. Under US GAAP, dividends paid is treated as a cash flow from financing, not a cash flow from operations. Now, this is a bit strange, therefore, because we've got interest paid going through CFO, but we've got dividends paid going through CFF. And of course, both of them are payments to the providers of finance. Okay, whether we're paying debt, whether we're paying equity, it just seems a little odd that the payments to the debt holders, the interest element, goes through CFO, but the payments to the equity holders, the dividend element, goes through CFF. So watch out for that peculiarity under US GAAP. Now, our cash flow from investing is really all about the PP&E, the property, plant and equipment, the intangibles and investments as well. So it's going to be the cash that we spend buying new plant, property and equipment. It's going to be the proceeds that we receive when we dispose of any property, plant and equipment. It's also going to be the cash that we pay when we acquire other business. So in other words, cash paid for investments in joint ventures and affiliates. Now remember, an affiliate is the same thing as an associate. Associated undertakings are where we have influence over the other entity, but not outright control. And we'll talk a lot more about that in the Level 2 syllabus. Payments for businesses acquired. This is us purchasing subsidiaries here. Purchases and sales of intangible assets as well. So really what we're looking at is purchases and sales of our PP&E, our intangible assets, and essentially our investments. Notice as well we've got purchases and sales of marketable securities. Now, if you remember our marketable securities from an earlier module, we talked about held to maturity securities, we talked about available for sale securities, and we talked about trading securities. Now, just be careful here. When you look at purchases and sales of marketable securities passing through CFI, it is essentially just the held to maturity and available for sale. So just watch for that. Why does it not include the trading securities? Well, notice our trading securities are part of cash flow from operations. Why would this be the case? Well, if you're holding trading securities, what you're really saying is trading in these securities is part of your core business operations. As a result, you're likely to be some form of financial institution, some kind of fund maybe, or some kind of investment bank where trading these securities is part of your day-to-day business operations. And because it's part of our day-to-day business operations, it should pass through cash flow from operations rather than cash flow from investing. The other one as well is cash equivalents, which we're going to treat as part of balance sheet cash. Remember, a cash equivalent is typically a short-term money market instrument with less than 90 days to maturity. Then finally, our cash flow from financing, and again, we're really looking at a US GAAP based criteria here. So it's the cash that we receive when we issue new common stock. It's the cash we receive if we issue any preferred stock, and of course the cash that we receive when we issue debt. Now be careful, when we talk about debt, under US GAAP, the principal flows are passing through cash flow from financing, but the interest flows pass through cash flows from operations. So it's the cash essentially that we spend when we raise both debt and equity. It's also of course any cash that we receive when essentially, the cash we receive when we issue debt and equity, the cash that we pay, of course, when we redeem debt and equity. So when we pay off principal or we buy back shares, treasury stock. Notice, of course, dividend payments. Remember, dividends received pass through CFO under US GAAP, but dividends paid pass through CFF. Now, we've told you here it excludes indirect financing. Now, one way of financing the company is simply by stopping paying your suppliers. Now, that's what they mean by indirect financing via accounts payable. Stop paying your suppliers so cash stops leaving the business. Now, what we're going to see later is if accounts payable changes, this affects cash flow from operations rather than cash flow from financing activities. Our next little LOS here asks us to describe the reporting of non-cash investing and financing activities. Well, of course, if we're buying or selling something and it doesn't involve a cash flow, then it's not going to appear in the cash flow statement. However, what we do find is it's going to be disclosed in the footnotes. So we need to be aware of some transactions that don't involve any cash flows. Now, the first one we've got up there is a convertible bond. Now, of course, a convertible bond is a bond that can be converted into equity. So, of course, if a convertible bond is converted into equity, the equity is going to change, but no cash flow is actually raised. Assets acquired under capital or finance leases. Here, you're buying an asset, up goes your asset, and also up goes a liability equal to the present value of the future lease payments. But no cash flow changes hands up front. Purchase of assets via issuance of debt and equity. So in other words, rather than paying cash for the assets we acquire, maybe we could issue a bond or issue some shares. Okay. An exchange of one non-cash asset for another, so barter transactions where we're exchanging assets rather than paying cash. Another one, of course, we get is stock dividends. Remember, these are purely cosmetic transactions where the number of shares are going to go up even though the company receives no additional cash. Now, an important slide, this one, the differences between US GAAP and IFRS. First of all, when you look at it, notice US GAAP. It is prescriptive. It is telling you where these items go. And there's no, therefore, subjectivity. And remember, that's because US GAAP traditionally has been a rules-based approach. But if you remember, IFRS was a principles-based approach. IFRS is more interested in economic substance. As a result, it gives you flexibility about where certain items will be presented in the cash flow statements. And really what it's doing is, under IFRS, it's saying, place the element into the cash flow statement where you believe the true economic substance of the transaction lies. So IFRS is allowing you to report economic substance, whereas US GAAP is rules-based approach in the cash flow statement. So let's break this down. Interest received. As we said earlier, receiving interest always goes through cash flow from operations under US GAAP. Under IFRS, it can go through CFO or CFI. What IFRS is saying here is, hang on a second, is receiving interest part of your core operations? If receiving interest is part of your core operations, hey, then treat it as a cash flow from operation. If it's not, if it's sundry to your core operations, it's secondary to your core operations, then let's treat it as a cash flow from investing. So let's think about that. Hey, maybe I'm a retail bank. So in other words, I make loans, I take deposits. Well, in which case, receiving interest on the loans I make is part of my core operations. So I'd expect interest received to be passing through CFO. Now let's take Kaplan, an education-based company. Is receiving interest part of our core operations? Well, no, education is our core operation. And therefore, we're much more likely to treat the interest received as a cash flow from investing activities. We can do the same with interest paid. US GAAP says put your interest paid through CFO. IFRS says, well, let's think about this. Is paying interest part of your core operations? Well, again, for a company like a bank, it is part of the core operations, paying interest on deposits made by customers, so it would pass through CFO. However, for a company like Kaplan, paying interest is not a function of our day-to-day operations, it's a function of our capital structure, how we finance the entity. And as a result, we could put our interest paid through cash flow from financing. Same with dividends received, very similar as interest received. US GAAP says CFO. IFRS says, is receiving dividends part of your core operations? Again, if you're some kind of fund management vehicle, the answer would be yes, so you'd put it through CFO. If essentially receiving dividends is not part of your core operations, then pass it through CFI. Dividends paid, remember US GAAP here rather strangely says, well, we're going to put this through CFF. Again, I kind of have issues with that. Why are we putting interest to the debt holders through CFO, but payments to the equity holders through CFF? Okay, don't worry why, it's simply the rule under US GAAP. But notice what IFRS is saying. It's saying, well, look, if essentially receiving dividends is part of your core operations, put it through CFO. Okay, or if paying dividends is part of your core operations, put them through CFO. If, however, paying dividends is not part of your core operations, treat it as a cash flow from financing. Other differences that we've got are taxes, the cash taxes paid. Under US GAAP, all of the tax will pass through CFO. Under IFRS, the payments we make under tax can be split between CFO, CFI, and CFF. In other words, if we've got any tax as a result of the profits on our day-to-day business activities, let's put that through CFO. Maybe we've got a tax liability because we've disposed of an asset. Well, we'll put that through CFI. And maybe, essentially, we've got a tax liability because we've retired debt early. Well, we'll put that through CFF. So in other words, IFRS looks at the source of what's causing the tax and says, hey, split it between the three classifications, whereas US GAAP does not. Another difference is bank overdrafts. Now, bank overdrafts under US GAAP, we treat the bank overdraft as if it was a debt instrument, so it passes through CFF. Under IFRS, the bank overdraft is not treated as a debt instrument at all. Instead, it's included as part of the cash. So it's in the balance sheet cash figure that we're reconciling between under IFRS. Okay, so we now move on to an LOS that asks us to distinguish between the direct method and the indirect method of computing cash flow from operations. So we've got two ways of computing cash flow from operations, direct versus indirect. Both will give us exactly the same results. It's just how we get to CFO is slightly different. Now, the direct method, I always think this is the most logical way of doing it. It's going to show you the actual cash inflows and outflows from each source of finance, i.e. the cash we collect from our customers, the amounts we pay to suppliers, the amounts we pay to the tax authorities, etc. Now, I think of the indirect method as being a shortcut to the direct method. What it's simply going to do is it's going to take net income, it's then going to strip out all of the non-cash items and make adjustments for working capital. Now, it's going to end up giving you the same CFO figure as the direct method, but how we've arrived at it is a lot less clear. We get a lot less information on how the company actually generated and spent cash when we use the indirect method. Now, when you look at the accounting standards, especially US GAAP, it says the direct method is preferred, but it gives companies a choice, direct or indirect, and you tend to find in practice a lot of companies use the indirect method because essentially it's a bit quicker. But as I said, I think of the indirect method as a shortcut to the direct method. Now, our next little learning outcome statement here asks us to describe how the cash flow statement is linked to the balance sheet and income statement. So we've got a little example of this. We've got an accounts receivable T account, as it's called. So these are the amounts, accounts receivable, of course, the amounts that our customers owe us on credit sales we've made at the year end. Now, the idea here is we're going to use balance sheet information and income statement information to try and derive what the cash flow figure should have been. Because, of course, in our cash flow statement, we don't show sales, we show the cash collected from our customers. Well, let's have a look at our balance sheet data. So we've got last year's accounts receivable. So at the end of last year, customers owed us $18,000. And also, we've got this year's balance sheet figure. So at the end of this year, our customers owed us $20,000. Now, if we turn to the income statement, we can see that we made sales of $200,000. Now let's think about it. If we were owed $18,000 at the start of the year, we then made credit sales of $200,000. If we collected no cash, we would have been owed $218,000 at the end of the year. But we're not owed $218,000, we're only owed $20,000. So therefore, we can deduce that the cash we collected from our customers must have been $198,000. Okay, so notice, armed with essentially income statement data and 2 years worth of balance sheets, this year's and last year's balance sheet, we can derive the cash flow figures. Now, there's a slightly quicker way of doing this, and we're going to see us doing this when we look at the direct cash flow method a little bit later. If we take our income statement amount, $200,000, and we look at the change in the balance sheet asset, this has gone from $18,000 to $20,000. That's a $2,000 increase. Well, what we do is we deduct increases in assets, we add increases in liabilities. So I'm going to deduct that $2,000, and notice I get the figure $198,000. Okay, that's how we're actually going to do it in the direct cash flow method. So we're not going to set out large T accounts, but I think you just need an awareness that when we do the direct method, essentially we're taking this approach. We're taking an income statement figure and using 2 years worth of balance sheet data to derive the cash flow. Now, cash inflows and outflows, so some general rules. We just saw that we deducted an increase in an asset. Why? Well, because look, increases in assets represent outflows to the company. a cash outflow to the company. So we're going to find that we deduct increases in assets. Likewise, a decrease in an asset must be an inflow to the company. Why do you decrease your assets? Why is your inventory fallen? Well, presumably because we've sold it. Why is our PP&E drop? Well, maybe we've sold it on. So decreases in assets represent inflows to the company. So as a result, when we're looking at cash flow data, when we're adjusting the income statement item, we're going to deduct increases in assets, but we're going to add decreases in assets. Now, when we look at liabilities and equity, it's the other way around, essentially. If a liability is increased, it is an inflow for the company. Imagine that your accounts payable have gone up, the amounts that you owe your suppliers have gone up. Well, that's because we haven't paid our suppliers, and that represents an inflow, or at least a reduction in an outflow to the company. So on the other hand, liabilities that decrease must be an outflow. Why do your liabilities decrease? Because you pay them off, and that paying them off, of course, is a use of cash. So we're going to end up with the rules that we're going to add decreases in assets, but add increases in liabilities, and we're going to subtract outflows in assets. So we're going to subtract an increase in an asset, but a decrease in a liability. Don't worry too much about that now. We're going to see it in practice in just a little while.